Welcome back to the channel, and thanks for joining me. I'm Algabot, and here we break down automated trading strategies for MetaTrader 5 in plain, educational language. Today we're examining an expert advisor called Engulfing Displacement Hedge. It's a pure price action strategy, which means there are no moving averages, no oscillators, and no indicators of any kind. Every decision comes from the raw candles themselves. By the end of this video, you'll understand how it reads market structure, how it spots a momentum breakout using an engulfing candle and a fair value gap, and how its protective hedge layer responds when a breakout begins to fail. Let's get started. Let's start with the big picture. The Engulfing Displacement Hedge expert advisor is built around a single idea that traders have studied for a very long time. When price breaks out of an established level with real momentum, that move can continue, and when a breakout fails, the snapback can be just as meaningful. This strategy tries to read both sides of that story. It is described as a pure price action approach. That phrase matters. There is no relative strength index, no stochastic, no moving average, and no average true range anywhere in the logic. Instead, the strategy works directly from the open, high, low, and close of each candle on whatever time frame you select. It looks at three things at once: the swing structure, which is the highest high and lowest low of a recent window of bars, the candlestick pattern, specifically an engulfing candle, and a displacement imbalance, which is a 3-bar fair value gap that suggests a strong institutional thrust. The market it's aimed at is a liquid, breakout-prone instrument. The source notes examples like a major currency pair such as the British pound versus the US dollar, or an index such as US 30, on the 5-minute to 15-minute time frames. Those are markets that tend to produce clean structural breaks rather than slow, sideways drift. So what kind of trader is this educational example suited to? It's a study piece for someone interested in structure-based, mechanical trading, where every rule is objective and measurable. It's also a useful illustration of hedging mechanics, because it adds a protective opposite position when a breakout starts to reverse. Please remember, this is educational information only, not financial advice or a recommendation. Trading carries real risk, and losing trades are a normal part of any strategy. Our goal here is simply to understand how the code thinks, condition by condition, so you can study the concept for yourself. Now let's walk through exactly how the strategy makes a decision. Everything happens on a freshly closed bar, and 3 price action conditions must line up before anything trades. The first condition is the break of structure. The strategy looks back over a window of bars, set by the StructureLookback parameter, which defaults to 20. It finds the highest high and the lowest low in that window. Those two levels form the resistance shelf above and the support shelf below. For a long, the just closed signal bar must close above the resistance shelf. For a short, it must close below the support shelf. The second condition is the engulfing pattern. For a long, the signal bar must be a bullish candle that fully engulfs the previous candle's body. For a short, it's the mirror image, a bearish candle engulfing the prior body. This helps confirm that the breakout came from a decisive candle rather than a quiet drift through the level. The third condition is displacement, measured as a 3-bar fair value gap. For a long, the high of the bar 3 back must sit below the low of the signal bar, leaving an unfilled gap on the way up. For a short, it's mirrored. This is toggled by the require FVG parameter, which is on by default. On top of those 3, there's a momentum filter. The body of the signal bar must be larger than the momentum body factor, defaulting to 1.0, multiplied by the recent average range. Only decisive candles qualify. When everything aligns, the EA places the trade. The stop loss sits just beyond the signal bar's far extreme, plus a stop buffer points cushion, so it rests at the level the breakout needs to hold. The take profit is the stop distance multiplied by RewardRisk, which defaults to 1.8. Then comes the distinctive layer, the hedge. Breakouts fail, and if price reverses by HedgeTriggerPoints against an open position, the strategy opens an opposite position with its own fixed take profit and stop. The basket becomes roughly market neutral while the reversal plays out. When the original trade finally closes at its stop or target, any surviving hedge is closed too, so the account returns flat, one clean life cycle at a time. Let's read the actual meta editor code on screen. At the top are the input parameters. StructureLookback sets the swing window for the support and resistance shelf. Average range period and momentum body factor define the momentum filter. Require FVG turns the fair value gap requirement on or off. Stop buffer points and reward risk shape the stop and target, while hedge trigger points, hedge reward points, and hedge stop points control the protective hedge. Lots is the primary trade size. Now the long block. The condition reads, if bull engulf is true and the signal bar's close is above resistance, and either the fair value gap isn't required or a bullish gap exists. When all of that holds, the entry is taken at the ask. The stop loss is the signal bar's low minus a buffer. The code measures the risk as entry minus stop, clamps it to the broker's minimum distance, and then sets the take profit as entry plus reward risk times that risk. Finally, it calls trade.buy with the stop and target attached. The short block is the exact mirror. If bear engulf is true, the close is below support, and the bearish gap condition is satisfied, the entry is taken at the bid. The stop sits above the signal bar's high. The risk is stop minus entry, and the take profit is entry minus reward risk times the risk. Then trade.sell sends the order. Both sides share the same structure, just flipped in direction. Let's walk through this illustration candle by candle and watch both a long trade and a short trade unfold. Remember, the strategy uses no oscillator at all. The two dashed lines you see are pure price structure. The blue resistance shelf at 1.2750 and later the gold support shelf at 1.2788. Look at the first few candles. Price is moving sideways, pressing up against the resistance shelf at 1.2750 but failing to close above it. Each time it reaches that blue line, sellers push it back down. The strategy is quietly mapping this level as the highest high of its look-back window. So that's the Engulfing Displacement Hedge Expert Advisor. We covered how it reads market structure with no indicators at all, how it requires a break of structure, an engulfing candle, a fair value gap, and a momentum filter to line up before it acts, and how it places a structure-based stop with a reward to risk take profit. We also looked at its protective hedge, which responds when a breakout begins to fail, and how it returns the account flat at the end of each life cycle.